Thank you, and welcome to Wealth Building Secrets for Real Estate Investors. This is a brief review of the original webinar by Ebere Okoye and TJ Bencho on year-end tax planning and Pittsburgh ranked best city by National Geographic. Our special guest, Ebere Okoye, is a CPA, an active real estate investor, and founder of Wealth Building CPA. She owns real estate investments in 5 states across the Eastern Coast. Her company has helped over 5,000 people like you prepare their taxes online and offline. Her greatest joy comes from helping clients, friends, and associates become free of financial stress. You can reach her on 1-888-502-3767 or at www.wealthbuildingcpa.com. TJ Bencho is the co-owner of Aurora Real Estate Investment Services, which is a family-owned and operated business in Pittsburgh. They have built a proven system that takes all the guesswork out of real estate investing. Scope of webinar. Once December 31st has come and gone, your tax liability for the 2011 tax year will be set in stone. Until then, and especially now that your final tax picture for 2010 is becoming more clear, year-end tax planning presents a unique last chance to lower your tax bill. It's an investment in time well worth considering. Tax preparation for the March 15th or April 15th return is not considered advanced tax planning. It's merely tax compliance as opposed to voluntary tax reduction planning. Though returns aren't due until April, they cover a tax year that ends December 31st. Some of the best tax reduction moves really need to be done by mid-November or early December. They often take some advanced planning. Getting a head start could make you a lot happier in April, giving you a bigger refund or a smaller check to write to Uncle Sam. Steve Jobs will forever be remembered as the engineer who most shaped our technology into the future. If Steve's fortune goes to his wife, there won't be any tax. The spouse can inherit a fortune with no estate tax as long as she is a U.S. citizen. But any that goes to any place else is subject to tax. Joe Robbie, who owned the Miami Dolphins and the stadium, died and his kids had to sell the Dolphins to pay the estate tax because it was his children who inherited, and children do not escape the estate tax. Kim Kardashian and Humphries. Capital gains. You can exclude up to $250,000 if single and $500,000 if married on the sale of a marital home. If one spouse moves out and the other stays, the staying spouse's time counts for both spouses. Rule is that you need to have lived in the house for 2 of 5 years. Alimony is taxable income to the recipient, and it's tax-deductible to the payor. Child support is not taxable income of the recipient, and it's not tax-deductible to the payor. Preferred payment depends on if you are the recipient or the payor. First, reduce your tax liability. By taking certain steps now, before 2011 draws to a close, you can reduce the size of your tax bill otherwise due when you file your return next year. Managing what income you recognize or defer also can pay dividends as you focus on balancing your tax rates between 2011 and 2012 and beyond with tax reform on the horizon. Secondly, your circumstances may have changed. Year-end tax planning is not only about what is happening in Congress and at the IRS. Addressing the changed circumstances in your life has always been a large part of year-end tax planning. What you planned for at the beginning of 2011 may not be what you are faced with now. Changes in your employment status, family, investments, or retirement plans raise new tax issues. 3. Plan for losses. A special word about losses, especially as this difficult year draws to a close. Matching losses with gains is not necessarily a simple task in the tax law. Different rules apply to different losses. Losses can be ordinary losses, passive losses, at-risk losses, capital losses, hobby losses, casualty losses, gambling losses, or Code Section 1231 losses. Knowing the differences and acting before year-end to match them correctly can mean significant tax savings. 4. Plan for deductions. Planning for deductions and credits at year-end can also get complex but can be equally as rewarding. Timing and qualification rules create traps and opportunities. Prepaying certain expenses, such as real estate taxes or mortgage interest, do not necessarily translate into a larger deduction this year. Year-end charitable giving generally has always been a smart way to reduce current year taxes, but strict timing rules and revised substantiation requirements for property donations cannot be overlooked. Homeowners should also not ignore taking advantage of the new Residential Energy Property Credit, which has a unique set of rules on qualifying expenses and deadlines for installations. Here's a client testimonial from JB. He's a real estate investor with multiple rental properties and properties rehabbed for property. The IRS audit stated he does not have a viable business. The initial audit assessment was for over $22,000. Through my audit representation and strong real estate business defense, audit adjustment was revised to $1,348. He received an additional check from DC for over $2,400. For a limited time only, it's $97, and it's valued at $299. Do-it-yourself year-end tax planning kit. Here's what you get. 100% of your fees will be credited to your tax preparation invoice. Year-end tax planning software and checklist to assist you in implementing a year-end tax savings plan. Keep more of your money in your pocket. Tax expert Al Aiello's powerful money savings reports for investors. Powerful insider secrets to avoid IRS audits. Millionaire tax strategies for real estate investors. Year-end tax planning strategies for real estate investors. Free review of your prior year tax returns. Here's a sneak peek of the 10-step process to reducing your overall tax liability. Step 1. Determine year-end tax planning method. Step 2. Gather the items needed for year-end tax planning. Step 3. Generate a list of significant events for the year. Step 4. Prepare your tax estimate. Step 5. Determine which tax planning scenario applies. Step 6. Generate strategies you can implement before year's end to reduce your tax liability. Step 7. Consider other compliance items for superior record-keeping and IRS audit defense. Step 8. Implement those strategies before December 31st. Step 9. Actual versus year-end comparison. Step 10. Help for when you're stuck. Or, for a limited time, only $297, valued at $599. Done for you year-end tax planning. Here's what you get. Analyze your tax return based on pay stubs, YTD business profit and loss, and other factors to come up with year-end tax reduction strategies. Ensure that all businesses are in compliance and not audit-prone. 50% will be credited to your WB CPA's tax preparation invoice. Free review of your prior year tax returns. Tax expert Al Aiello's powerful money savings reports for investors. Powerful insider secrets to avoid IRS audits. Millionaire tax strategies for real estate investors. Year-end tax planning strategies for real estate investors. Free review of your prior year tax returns. In its August 2011 issue, Forbes magazine cited Pittsburgh, Pennsylvania as one of the cities where housing is recession-proof. The median home price is $110,400. The second quarter 2011 price increase, 2.8%. First quarter 2011 price increase, 1.2%. More about Pittsburgh. There are 2.4 million people in 7 counties. It's the 22nd largest city in the U.S. It's known as the City of Bridges, with 446 of them. Also known as the Steel City for its former steel manufacturing base. Downtown revitalization offers exciting nightlife. The Dark Knight Rises was just filmed here, and the next Tom Cruise movie is being filmed now. If you want more information, contact Abere on 1-888-502-3767 or at www.wealthbuildingcpa.com or at info@wealthbuildingcpa.com. TJ can be reached on 412-498-2790 or tjbencho@comcast.net or www.investinpittsburgh.net.